Please give a big welcome to the first panel of the conference, Global Finance and Capital Markets, moderated by Dino Paparelli, Global Head of Commercial Real Estate, Deutsche Bank Securities, and the panelists, Andrea Balkan, Managing Partner at Brookfield, Jeffrey DiModica, CFA and President, Starwood Property Trust, Jesse Hom, Managing Director and Global Head of Real Estate Credit and Capital Markets, GIC, Tim Johnson, Global Head of Blackstone Real Estate Debt Strategies at Blackstone, and Miriam Wheeler, Partner and Managing Director, Head of the Global Real Estate Financing Group at Goldman Sachs and Company. Please welcome our panel.
Dino, we need baseball walk-up music next week.
Yeah.
Like a rockin' song.
So, morning everybody, quick introduction. First of all, congratulations to the organizer of the event. The room is getting bigger and bigger. There must be a reason. Thank you to Mike Norman, the Dean of New York Schack, and all his staff. And then thank you to Robert Blumenthal, the chair of the conference. Allow me for some Deutsche Bank pride. Let's kick off. We usually start discussing about risk in general, macro risk. We then move into liquidity, and then we discuss about some of the main themes on asset classes and opportunities. So let's go in order. Last year we started with Miriam. This year we start with Tim. Generally speaking, Tim, we've been this panel in November. A few years ago, we're discussing COVID. There was inflation. There was rates. What's your main concern today? What are the risks out there that affect you the most?
Yeah, I think the positive news is that inflation is definitely being controlled now by the Fed with this move in rates, and that's clearly having a strong impact. And from what we see in our own portfolio, probably even a stronger slowdown in inflation than what is being reported. Those numbers tend to be a little bit trailing. So that's the good news. The other side of that is the whole point of this is to slow the economy down, and I think that's. The thing that we're going to keep the closest eye on this next year is, we do expect rates to continue to stay elevated for a while. I don't think this turns around real quickly. I think the Fed wants to make sure that they, get this all the way under control, and they'd rather, reduce rates, too late versus too early. So we expect a slowdown in the economy to impact, the broader economy, and that's going to have a flow through to real estate, of course. So I think that's, in terms of concerns, that's what we're most focused on for the next, for 2024.
Andrea, you want to chime in? Or Jeff?
I think I would echo, Tim's comment that obviously a slowdown in the economy, did the Fed push too much and end us up in a recession? That's kind of the near-term risk for real estate in general, for the economy in general. I think we can't also avoid the risk that's harder for us to address, which is just general geopolitical risks. None of us know, what's going to happen and what kind of impact that's going to have on the economy. So that's kind of the existential risk we're facing, like the COVID type risk. But the regular way risk is the economy. And
that's a very interesting point you touched on, Andrea, is the geopolitical risk. Okay, the event of the last 12, 18 months, 2 years now, shows that there is an unpredictable risk out there. And then, something that's difficult to hedge from a, capital market perspective. How do you think, the market's been, seems to be, not particularly affected recently? Is just because we're getting used? Or, I don't know, what you guys think about the geopolitical risk is that there is significant, but I haven't seen much of a, capital market reaction. What's your take, Jeff?
Yeah, listen, we just got through Ukraine, and now we have the Middle East, and I don't know how much worse it can get. And so we've seen what that sort of price is in. We didn't get the flight to quality and rates that I think we thought we would get in both of those situations, with rates going lower. They're finally going lower with some better inflation print. So, we've taken enough gut punches as an industry over the last year and a half or so that I think the geopolitical risk is shown us that the last couple of things haven't really been the bigger fact. The bigger fact is rates, and it's where Tim started. And the 10-year coming in, since if we did this in October, we would all be whining a bit. But we've had a pretty good run in rates here with 55 or so basis points in the 10-year, which is going to help cap rates and our valuations. But I think all of us as lenders have kicked the can to late 24, early 25, and the big change this year to me is that forward SOFR was pricing at a 270 forward SOFR in the beginning of 25, back in May of this year. Yeah. That went up to 450. At 450, our floating rate loans that we've kicked the can on, that probably won't have income growth to bail them out. We kick it because we're either going to get income growth or lower rates. We're banking on lower rates. We were banking on 270, and that went away to 450, and that got scary. So I wake up most mornings not thinking geopolitically, but looking right at where's the forward SOFR curve, and we're back into just around 4% or sub in the first quarter of 25. But if we don't see that forward SOFR curve play out, we're going to have a really difficult 24 and 25.
Yeah. You touch on that, a key point for our daily life. If you think about the last 12 months, it was a roller coaster. Supposed to have cuts. Last year people were predicting cuts in 2023. It didn't happen. We got spot rates at 525, 550. A month ago, 2 months ago, people were predicting 7%, and now we got the contraction on the rates over the last 3-4 weeks. What should we expect for 2024? Yes.
Yeah, I think
rate cuts or no rate cuts. What's your?
We were at the pre-panel dinner yesterday, and I think the DB head economist was calling for 175 bips of cuts and a 4% 10-year, which I think we would all see as very welcome news. Listen, from our perspective, the investment opportunities we're looking at, we're trying to account for a range of outcomes. I think, the short end of the curve feels pretty range bound. I think what we worry about is long end of the curve with treasury supply and bond issuance next year. I try not to be too affected by recency bias. In the last 6 weeks, it feels really good. Rate risks feels abated. But, I think what we worry about is like a retest of recent highs, whether it's policy missteps or energy shocks or sticky wage inflation, just from a sentimental, from a feeling perspective of borrowers, we just fear that catalyzes, borrowers conceding on projects if they start to fear that we're in a persistently high rate environment and kind of the cascading effects of that.
Gotcha. So let's see what happens next year on the rates. It's going to be interesting.
The problem is everyone in this room wants lower rates. Andrea and I have been doing this together since the 80s, I guess we started working together.
Exactly.
And every time everybody wants the same thing, it never happens. So I'm really scared that we will definitely retest the highs in rates.
Yeah. Let's change slightly the topic. Let's go more into something like more practical that we do on a daily basis. Is the last 2 years, probably mostly 18 months. Miriam, all of us have been working on the existing book. A lot has been some people call it extensions or restatement. Other people call it kick the can. Practically speaking, similar. Do you think this is going to be the way people would approach asset management going forward, or there's going to be a change with me more aggressive approach if you want?
I think in situations where you have borrowers who want to keep going on the properties that they own, you're absolutely going to see lenders kicking the can. We're seeing it in the CMBS market. If you look at behavior from special servicers are incentivized to get fees, to continue to have loans outstanding. They like workout fees. They like special servicing fees and default interest. So we're absolutely seeing in the office market, for example, that if you need more time, you can get it if you're willing to keep paying your debt service. And I think similarly, lenders don't necessarily want to take assets back. So if you can find solutions that work with borrowers to give everyone a little more time, I think you'll continue to see that.
I think the risk that we are though seeing now is a lot of borrowers are just capitulating.
Yes.
They're looking at their deal and saying, I'm underwater, and if I write a check, I can't write a check behind the senior debt because it's just good money after bad. And so they're approaching senior lenders and saying, let's figure out how to put the money in higher in the capital stack so we know we're going to get it back. And that's the right thing for everybody, but a lot of the banks are just frozen. So you go to them with a proposal, and we're a mezz lender, so we're kind of involved in this and working with borrowers on a lot of deals. But you go to a senior lender and you say, okay, here's the proposal. And it's going to take, 3 months, best case, 6 months, realistically, 9 months maybe, to get your senior syndicate to agree to what they all acknowledge is the best thing for them and everybody else. So it's the inaction that's the challenge.
The Fed did come out with guidance over the summer sort of in support of that A-B structure that you're describing. So I do think that that's a solution you'll see more of going forward. And the Fed basically said that if you can create an A note that is performing where you're getting paid current interest, you can treat that as a performing loan and then write off the B note. And so I think that you'll see more banks do that in situations where assets need capital, you need to do something, and that allows you at least to have a part of the loan performing, because banks are highly focused on those public metrics around how their loan portfolio is doing.
I agree. And then the challenge you see with that is the bank syndicates that have banks from every country.
Yes.
So everybody has a different goal. So if you've got US banks, German banks, Asian banks all together in one syndicate, that's where that's where our creativity comes into play.
You touch on a very important point. I guess everybody is dealing with this. Syndication by definition is reducing, diversifying the risk. The reality is, in a situation like today, putting the syndicate together is, in the best case, is time consuming. Let's put it like this, but it's laborious. Tim, you want to comment on this in terms of asset management?
Yeah, I think those were all really good comments, and I agree with them. I would say the thing the market probably needs the most is some level of price transparency, and that's been really hard, because if you're trying to do a workout with a bank or you're trying to get to an A/B note split, a lot of the challenge is agreeing on what the level is, and there's not been a lot of pricing action in the market, in office in particular. I do expect that this year we'll start to have more data points. There are, as Andrea said, there are more borrowers that are going to give up, and that results in lenders, selling assets or doing short sales or things like that start to get, bubble up what today's pricing is, and that allows people to start to make decisions a little bit more. Banks have been working on building up their reserves as much as they can, but it's been a challenge to stay ahead of it because values have been continuing to go down. So that just kind of needs to, reach its point where I think there's like a settling out, and a lot of this does come back to, the rates picture as well. I think a lot of the challenges that everybody's having in the market is, higher rates are one thing, but tremendous amounts of rate volatility make it really hard to agree on anything. So I think that, the challenge will be a little transparency in the market. I do expect that to, we're already seeing it starting today with some assets selling and starting to set pricing levels. And in 2024, I would expect we'd see more of that.
But the limited pricing transparency, it's not being crystallized, but I think you're getting indications from the market. People don't like the answers. And so the whole kind of real estate complex, I think every constituency, whether it's regulatory, lenders, borrowers, I think a lot of people have a lot of challenges with a limited amount of resources to deal with those challenges. So I think there's alignment, so long as borrowers or investors aren't wasting collateral, to just kick the can and buy time.
So on this point about, some transparency start getting there, short sale, we heard about, some capitulation. Are you expecting, some sort of, a flow of opportunities in, short sale, distressed debt in the next 6 to 12 months?
I mean, I think you're going to see an increasing volume of it. I still believe that, if you look at like the SASB payoff rate this year, I think it was like 30% pay rate on office. I don't see that creeping up materially anytime soon. I still think that you're going to have an overwhelming majority of extensions, but I do think you'll see a slow trickle of these opportunities.
And I think the banks will likely have enough capital to sit on assets to wait for a better market for the reasons Tim talked about. There is no liquidity, there's no price transparency. It's probably the worst time October was the worst time to sell. We're close to the worst time to selling. So my gut is that you will see most people away from regional banks who are all structurally insolvent to liquidation, period, hard stop. They didn't hedge fixed rates. If you own a 10-year bond and rates are up 100 basis points, your 10-year bond is worth 90, not 100. And if you're 9 times levered, you have no equity left. Throw in goodwill, PP&E, deferred tax assets, and a bigger than 100 basis point move into liquidation. Every regional bank is structurally insolvent if you had to liquidate their assets. That's where the fire sale would potentially come from. But I don't think the Fed's going to force their hand. I think they're going to try to keep as many alive after you had the Lehman Bear equivalent kind of go already. My gut is you don't see that. So my gut is that the banks don't force sales on us. And that's probably good for the stability of the market in a market where there's very little transparency.
I think the one place where you could see more bank sales is if you start to see some bank consolidation and M&A. In M&A, you really mark your assets, and so therefore you then own loans at a price where you can actually transact. I think there are a lot of regional banks in particular who would love to sell their real estate books, but they need to sell them at prices that aren't achievable in the market today. So maybe if we see that M&A, you'll actually see a couple more sales.
Jeff, let's stick to a second on the values, okay? I don't know, the experience of the last few months in particular, whenever you get a new valuation, you hold your breath because you don't know what you're getting. I'm not criticizing the appraisal, it's just lack of data points make it more volatile. Where do you think we are, in terms of asset repricing? Do you think the values somehow are getting towards, the bottom? Are we basically more to come? I know visibility is limited, data points are limited, but we start seeing some transactions. Where do you think we are in asset repricing?
Yeah, I think if you have to sell an asset today, you're not going to have an outcome that you want, mostly because the asset you're going to sell is probably office, and you're probably going to have a hard time finding debt. And I might be willing to do more office, but in a public vehicle, 10.5% of my assets are on U.S. office, and my loans are on U.S. office. So I don't want that to be 11 or 12 or 13, so I'm going to bid it way back. When I go to Miriam or any one of my bank partners to finance it, they also don't want that percentage to be higher. So I think we need to get to a better market. You look back 5 years ago, no one wanted to touch retail. 2.5 years ago, no one wanted to touch hotels. Those are probably both pretty good investments if you made them there. I think there will be equity capital that will rally behind these prices on office if they can figure out what the cap rate is. But they have to find financing, and it's not that easy to find financing. So I think we're close to the lows if I believe the forward curve, but every decision I make goes back to, if the forward curve is wrong, how do I protect myself? Because if we end up at a 4.5 to 5.5 SOFR curve for a couple more years, you're going to regret anything you bought.
Gotcha. Just change topic a little bit more into, capital markets liquidity. We read every day about, refi wall, funding gap. A lot of transaction, a lot of refinancing were pushed, so we have definitely an upcoming, volume of transaction need to be refied. Do you think we have how big is a refi wall that you can expect for 2024? Do you really think how big is the funding gap that the market will need to deal with? And what is this funding gap? Is it the bottom or is it the senior? That's actually, to me, is a interesting, point to discuss.
Yeah, I was just gonna, I think, in terms of the funding gap, higher rates just change the math on everything. So any loan that was put in place in, the low rate environment and cost of borrowing was, 2 to 3%, and now it's 6 to 7%. That math just is different. So the constraint used to be loan to value in terms of what a bank or, insurance company would lend on a senior loan, and now the constraint is debt service coverage. And the result is that pretty much every loan, whether the asset's performing extremely well or not, has kind of a shortfall at refinancing in terms of the proceeds available from the same senior lending source. And so that just creates a situation where pretty much every loan is going to require some rebalancing, and the equity might put in that money in many cases. Might start to push some sales of real estate just as loans come due and need to be dealt with. And there's also the opportunity for subordinate lenders like a lot of us up here to fill in that gap with the equity in concert with them. I think that gap is pretty much every loan put in place over the last 2 to 3 years, and is going to need to be worked out. And then the great part of that and the opportunity set is a lot of it's going to be on really high quality performing real estate, but the scale of it's large enough that not every deal can be re-equitized. And I think the opportunity set for all of us, we've been kind of waiting. It hasn't really been here in a material form. There's been some opportunities, but what we're all talking about, kind of pushing things out has been the case. But I think as balance sheet lenders are ultimately going to need to reduce their commercial real estate exposure somehow, some way. And if office is totally illiquid, it would make logical sense that one of the ways to reduce is just to run off the other asset classes to a certain extent and push those out into the refinancing market and get some activity going. So I think that it probably would make sense that actually the better assets get pushed into the market to get refinanced, because they can be refinanced and the equity can deal with it, and it's kind of their problem and banks can move that on. So I think that opportunity set's going to start this year and in 2024 and 2025.
To Tim's point, we ran some math around the current CMBS universe just to look at, in today's rate environment, how much of it could get refinanced by senior lenders. So putting aside gap capital, putting aside mezz, it's only 25% of the current market that you could actually refinance as is. So I think that's a pretty staggering figure when you think about 75% of the loans out there need additional capital to refinance today. Now, clearly, the rates market could change. Loans could get extended, so that number may not be the permanent number, but that's what we think it is today. You know, I think in terms of funding gaps, the other area where we don't see a ton of liquidity is frankly in the CMBS market. So the market's open, it's functioning, but if you look at the buyer universe, we really aren't seeing banks participate. Banks used to be a very significant percentage of the AAA buyers. They're pretty much out. Insurance is buying, but insurance has a very selective credit box, and so that's limited. So you're very much reliant on the money managers right now. Now, we do think that they should have inflows in this current rate environment. Fixed income is attractive to own, but you're reliant on 10 or 11 bond buyers to really have the market function. And so I think there's not only a liquidity gap sort of at the bottom, but the AAA market's pretty thin.
It's very, it's in front of everybody. But let's stick to CMBS. Talking about source of liquidity, CMBS is one of the main source of liquidity for the real estate market. This year production in the US has been probably one of the lowest ever. I don't know if we're talking about 45 billion issuance versus 70 last year, which was already not particularly prolific year, a 110 in 2021. Quarter four sort of was a change in dynamic in the CMBS issuance. How do you see this, taking us to 2024? What's your expectation for the market? Would you expect more liquidity coming in the CMBS bond market? Another point for quarter four this year, not because it's too much of a correlation, but 3 CMBS issuances in Europe in a quarter, something that we have not seen since I started working a while ago. So it's do you a sign of liquidity coming back in the CMBS market? And what's your take?
Yeah, so we think that you'll see about 64 billion of issuance next year versus the sort of high 30s this year. So we do think that there's going to be an uptick. I think a lot of it is a question of what borrowers do. I think this year there were a lot of deals that could have gotten done, but where borrowers sort of had the hope and kick the can strategy versus financing where coupons were today. So I think we are starting to see some of our more sophisticated borrowers say, look, I can't keep doing these 3-month, 6-month extensions. I'm actually going to take my medicine and finance today. I'm going to do a 5-year fixed rate deal instead of a floater, so I at least have some runway. We're also seeing borrowers explore other markets. So I think if you look at the corporate market, which has held in much better than CMBS this year, we're seeing a number of folks actually test that market in addition to CMBS. It finances growth a little more efficiently. But I think you'll see more next year. Now, I don't think it's going to be office. Office is going to continue to be a small percentage and probably only in the conduit. But other asset classes have enough cash flow to get done. And so I think you'll see some more deals. Your comment on Europe is interesting. We still think that in Europe, the cost of funds from the banks is much more attractive than CMBS. So in a lot of situations, you could do CMBS in Europe, but it's 100 basis points wider than where you could finance yourself otherwise. So we're hopeful that you see more there, but I think it's more a question of what happens to the banks in Europe.
We look at what's really changed in the last year, and to me what's changed is the insurance company bid. You have a fixed rate asset that the insurance companies really like the yield on, whether it's 7 or 8 or 6 3/4 maybe at the sort of tights. And insurance companies are piling in. So the CMBS market has to come with lower spreads than I think the CMBS market deserves today, to be frank. And I think the B-piece buyers are getting it. You've seen B-pieces go from 15, 16, 17% to 20 to 22%, depending on 5 or 10-year deals. And as I went through the last B-piece that my guy showed me, and we went through every asset in a 60-asset pool, I was really curious because I sit over a floating rate transitional book, and we sort of look at things on cash flow and cap rates that we think are realistic and debt yields that we think are sustainable. And as I looked at the last couple of CMBS deals, I think that the 55, 60 LTV that they're putting on the cover of the book is more like 85 LTV at my cap rate and in my NOI assumptions. So I think it's got pretty levered, and I think it's had to get levered to compete with the insurance bid, and we need the insurance bid to go away a bit, and that's probably a lower rate environment for CMBS to look attractive to the mezz buyer. You know, on the floating rate transitional side, all of us were earning 12 or 13% levered, owning our sort of pseudo mezzanine piece over the last bunch of years. We're earning a little bit more than that, but we're not earning enough more than that to make up for the fact that treasuries are 300 basis points higher. So on a versus treasuries, we are not we're creating sort of excess NIM. The only place you can get that today, I think, is in the bottom of these structured deals. But man, I don't love the credits, and I'm curious how you look at it. I just don't think we're anywhere near the LTVs that we thought we were at 2 or 3 years ago in CMBS.
Yeah, I think fixed rate versus floating, like fixed rate conduit, generally agree in terms of like, you know, the market as you laid it out. On the floating rate side, I think it's more attractive, and the buyer base isn't as aggressive on the floating rate side because you don't have that insurance company bid in as much. Some insurance companies are happy to own CMBS or whole loan floaters, but for the most part, they're looking for duration, and it's just really hard to find in this environment anything with duration if you manage that style of capital. So there is a bit of a little bit more of a food fight over things with duration today. But I do think on the floating rate side, it's super attractive actually as an investment, which, you know, probably, you know, should get, the market should tighten a little bit here because there's just not a lot of supply, and there's going to be less and less supply as, you know, as deals roll off. So I think that the long-term technical for CMBS is pretty favorable. The short term is it's real estate, and people don't want that really in scale. So I think floating rate CMBS looks pretty attractive today. And hopeful that market does open up a little bit more, because I think more issuance would be good for all of us as investors, and we own a lot of real estate, so borrowing money in the CMBS market is part of what we do as well.
And as a borrower, I mean, as a lender, I mean, one of the things that we've found attractive in the CMBS market is the SASB market right now. Mm-hmm. There aren't that many deals out there, but the deals that are out there, we're looking at the returns, you know, in the belly of the curve and saying, these are really attractive returns. Yeah. And if you're buying, you know, the bottom of a stack and you can appoint the special servicer, you've got a lot of protections that have been built into the CMBS SASB structure since, you know, the GFC. So it's definitely a place that we're finding some attractive opportunities.
I agree 100%. SASB looks the cheapest to me. Plus you have liquidity. You have the ability to leverage it. You can do whatever you want with it. People don't put a high enough price on liquidity until you need liquidity. And I think the SASB market looks really cheap today.
And then let's stick to you and change a bit beyond the source of liquidity. What's the outlook on the, you know, mezzanine lending in terms of liquidity, but also in terms of the approach to, you know, managing the existing book? Are you see this playing out in the new year?
So, you know, as we look at our business, I mean, there's two things. There's the existing book, and then there's the new business. And I would say, you know, historically, we were very focused in our business on, we'd originate a whole loan, we'd sell a first mortgage, we'd create a mezzanine. And that's given us the ability to negotiate restructurings on loans maturing on a one-by-one basis with the senior lenders, which has been nice, you know, not having to deal with kind of a warehouse lender, repo lender with mark-to-market. On a go-forward basis, we're still doing some of that core business, but we're also seeing interesting opportunities in, you know, rescue type of financings, recapitalizations, CMBS, as I mentioned, and then also, you know, construction lending. I mean, there are still some interesting, mainly residential projects getting done. And in the past, you would do a residential project at, you know, whatever your spread was, you'd have to sell the senior to create your return. Now you can do a ground up construction at, you know, 450 to 500 over and keep the whole loan and still generate your returns. So we're just, the market, because there are less deals, it's, you know, forced us to evolve into doing a lot of different types of deals with our new capital.
I'll ask you something about the mezz lender. You know, obviously you have a perfect visibility on the various players without getting in anyone specific, but specifically, but, you know, do you see the mezz lender ready to step up in the equity shoes in the case of sponsor capitulation or, you know, lack of interest? Is the market ready for the kind of move, or you think it's going to be more, you know, moving on?
I think the mezz lenders who have capital, you know, like us and others on the panel, are ready to step up. the new money has to earn the appropriate return, though. We're not going to, throw good money after bad. And unlike, the GFC, when, money was free, you're not going to just assume that, everything's going to kind of, grow its way out. We will, we have a lot of capital, as does everybody on the panel, and we're more than willing to step up, but we have to earn an appropriate return for the risk on the new money. And stepping up doesn't necessarily mean just take the building and put in money behind the senior lender. We're going to have to do A/B structures, and then we're more than willing to put money in to rescue the property at the right level in the capital stack.
And I think there's a great opportunity for lenders like you and Miriam to step up and finance other people's rescue deals when we want. We're in the mezz, we have a senior. It's a repo, and they have recourse to us. They have a cross against a massive pool of assets. They're never going to lose money. That repo is a AAA asset to them. But they have deal fatigue when you've gone through 3.5 years and the mezzanine is willing to take it over, and we own a pretty thick slice, and we've historically always taken over our defaulted deals. But I'm finding that the senior lender doesn't want to stay in, and they're going to sort of force our hand by giving us a very low advance rate and a very high cost of funds because they don't want to go in. And I think what's missing is people stepping in and financing, becoming the senior on someone else's deal. Because if it's new to you and you don't have 3.5 years and you're not frustrated by lack of business plan working out, then I think that there's a great opportunity to lend at 300 over at a really low advance rate. Again, picking up the cross from us, picking up the recourse, picking up the credit marks. And I think that needs to come back. The senior needs to come back for the mezz to really feel comfortable that we're going to take back all the assets. I don't know if you guys have the same experience.
Yeah, I think that's definitely fair, and I think also as it relates to like just the mezzanine lenders out there in general, there's the people up on this panel are folks with equity businesses, equity experience, a lot of debt experience, and a lot of capital available, and that's a set of people that I think the banks have liked having in their capital structures because it's really like a surrogate borrower. It's your next borrower if things don't go right, and we all have the capabilities to handle that. Not all mezz lenders are that, and there's a growing amount of situations where the mezz lenders don't have the capital, don't really know what they got themselves into in the first place. Not everybody has reserve structures in their funds and can deal with a big senior in front of them. If you're just 10% of the capital structure and you have 3 or 4 deals blow up and you didn't think ahead to needing to have a bunch of money to deal with all of it potentially at once, it can be a challenge. So I think you'll have a bit of a mess in some deals where the mezz lender just isn't home or doesn't have the capital to deal with things. Then you'll have other deals where you have more capable hands to deal with stuff. And I think as Andrea and Jeff both said, it's not always going to be super straightforward what's going to happen, what the mezz lender is going to do. But I think what you need the most is for that piece of the capital structure to take control of the situation and be the one who figures out how to get to a restructured deal that makes the most sense for everybody.
Yeah, I've been surprised to see how quickly mezzanine lenders have given up on their capital structures today, kind of in the current environment. I find that the borrowers have had much more lasting power. I think a lot of the credit investors underestimated, like Tim said, the capital intensity and the resource intensity in a downside scenario. And I think that's why you've seen continued consolidation in the players from a scale perspective, and why also like capital formation for new credit investors has been a little slower to form kind of this time around. So it's been interesting.
Yes, to stick to you and shift topic a little bit. It's New York City, 5 billion square feet of offices. It's the elephant in the room. Anybody, for everyone involved in real estate. What do you think is the future of office lending?
I get the office question.
Tell us.
Crystal ball.
Crystal ball. Yeah.
So I've been asked this before. So I think when we're trying to, I think we take a step back and we try to think thematically how office is going to play out in the capital markets response. And I think we look at the mall sector as a reasonable proxy for that. So for those in the room, it wasn't that long ago, like 8 years ago, where malls were actually like a darling institutional investment asset class. They were well banked by the capital markets on the credit side. There was a ton of appetite from large institutional equity investors. Valuations peaked like 2015 at like 4 caps. And that was on the back of like 20 years of strong fundamentals growing to the sky. When that ended up happening was fundamentals quickly deteriorated. It was a catalyst from technological change in consumer sentiment and behaviors, which was e-commerce. It was exacerbated by looking backwards, an oversupply backdrop and really high capital intensity as far as keeping people and spaces and rent rolls filled. And when you think about those dynamics and you look at office today, it's very similar, right? Technological catalyst and customer behaviors change between, Zoom and telecommuting. You have an oversupply issue and you have the capital intensity issue to sign leases. And so we sit like a decade later from the derating of malls today. And what you've seen is like a very clear stratification of asset quality. And the capital market support is highly, depends highly on where you fall within those tiers. So the top tiers, there's clear need for them. Customers like them, they're going back. Fundamentals have floored and they've actually recovered and pricing power is restored to the landlords. There's been no equity trades. But if you talk to like market participants on when people start to do work, it's like 6.5 to 8 caps compared to 4 caps in 2015. But you can still access financing, right? There's a lot of volume on CMBS SASB. I think that moves to balance sheet eventually for like top tier malls. Then you have like a big middle class where fundamentals have floored, but they're treading water. Very limited equity trades, double-digit cap rates, but no bank support. So all the lenders are just modifying, restructuring, extending, and trying to amortize through cash flow. And then you have the lower tier that are irrelevant, need to be demolished, redeveloped, reimagined. And so thematically, we see office kind of bifurcating into those tiers and probably a similar theme shakeout.
Let me ask you something. You have a global reach with your job, okay? So the reaction to office lending, office business in the US is different in Europe and is different in Asia. What is the reason for this? Different type of approach. Is it oversupply? Is it headlines? Is the change of the way people are going to work on the long term in the US? What is the reason behind this different reaction?
I think a lot of it is just the way the markets are set up from a supply standpoint. London has like roughly half the amount of office space of New York City.
100%.
It's just more supply constrained, and then there's additional constraining factors to new supply. There's a lot of ESG restrictions that are going to make some assets just not work anymore. So that's going to further reduce supply. And you have markets, frankly, in the European cities that look more like, literally just look more like US markets. If you look at them, they're bigger, newer buildings, bigger floor plate buildings, and they have fundamentals that are more akin to our fundamentals here in New York or San Francisco. Things are not so pretty, but when you go to the West End in London and buildings are 6, 7, 8 stories high, and there's just not a lot of them, and there's a lot of demand, the fundamentals are just a bit stronger. So I think the supply situation is just fundamentally different, and in Asia similarly so. And the back to office thing I think has generally gotten maybe more of the headlines than it deserves in terms of what it has done to the fundamentals of office. It's certainly been negative, but the fundamental challenges existed before COVID happened. But nonetheless, work from home is a little bit less impactful in a lot of European and Asian countries than it has been in the US.
Yeah, I mean, they returned to work. In the US, I think we're a little bit pampered and we all like nice office and we want to work from home, and the pushback, markets like DC, it's insane the fact that the government is still not forcing people back, right? So you've killed an entire market. And I think in Europe, people went back significantly earlier. And I think in the US now, this A-B bifurcation is greater here than it is anywhere else in the world because we're all pampered and we all want to be in A office. And so it's created a really difficult time for B office. For the students here, you think about an A office with $120 rents and a B office with $60 rents. The B office is worth half, right? Well, no. Now take net effective rents, which is what really matters. Take out TIs and LCs. People want $130 on B buildings today to make it look somewhat nice. You have to fix up the lobby. And if net effectives drop you $30, now you're $30 rents against $90 rents. You went from being worth half as much to a third as much. Now you throw in the fact that we don't want to be in B buildings, so the vacancy is more, and you're down to a quarter of the value. And at that 1/4 of the value, you're nowhere close to covering the debt service that you had from sort of pre-COVID. So I think it's return to work in the US that has pushed the envelope on the A-B differential, and the losses that we are going to see are in B office. A office is not losing money.
Change asset class. One of the asset classes we spoke a lot over the last 2 years is hospitality. Miriam, we've seen comeback of both RevPAR performance, also liquidity, also in the CMBS. what's your expectation going to 2024? Is the performance of the sector can keep the same pace? What's your view on this?
Yeah, I think hospitality has been certainly one of the darlings of the CMBS sector this year, and a lot of it is frankly just the cash flow. I think investors are highly focused on DSCR. Hospitality has seen tremendous growth, particularly on the leisure side from 2019 to today. I would say overall, we feel pretty bullish on the consumer. If you think about inflation now a little bit more under control, wage growth is still positive, though not as extreme as it was before. So the consumer is in pretty good shape. And I think not only do we expect to see continued positive fundamentals on the leisure side, we've seen a real uptick in urban hospitality this year as well. If you look at markets like New York, you've really seen a lot of growth here. And so I think hospitality will continue to be one of the sectors that is very active in CMBS. We saw M&A in the hospitality sector this year with the Hersha deal that just closed. I think one thing that we're highly focused on, though, is you have seen a lot of growth since 2019, and who knows if that's going to be fully sustainable. So I think the fact that you're losing all of your tenants on a nightly basis in hospitality, and you are seeing some increases in insurance and other expenses like that, something to watch, but we continue to think that it will be active.
Jeff, Sunbelt and Miami. Picking you because I think it's a question for you. You think this trajectory of asset price going up, offices going up, there's so many new condos being built in Miami. Is this sustainable? The second point of the question is, we have issues on increase of the insurance cost in coastal areas. How serious is the issue?
Yeah, so let's start with one. The Miami Miracle, I don't think is going to fade quickly. In previous cycles, you didn't have CEOs move there. Now all of the CEOs have moved there, and if they haven't, they're looking for houses. And so there's only 600 waterfront houses. Those continue to push. The CEOs will continue to come. That will create other jobs. I think we're probably building too much high-rise, mid-level multis that you can only sustain so much $4 to $5 rents in a market. That's close to managing director salaries, not vice president salaries, to afford it, and we probably oversupplied that. So if there's a place that Miami's going to see a difficult time, it's in multi. To your second question on taxes, multi is where the tax problem is in Florida. Citizens has stepped in. A lot of insurers have left Florida. You guys have obviously seen the named storm problem. Citizens is the state-run program that DeSantis realized in the last year that it will bankrupt the state if they have a big named storm. And so now Citizens is pulling back and starting to cancel policy. So the lack of availability for insurance is a big deal. Over the last 2 years, for somebody coming in on a one-off multifamily property in Central Florida, you're probably up 75% in insurance costs. You're up 125% over 4 years or so. It's a massive move. For the large guys, and all of us are larger owners, we have crossed large policies, and I think over a 5-year period, we're up like 60% and 23% over the last year. So it's significant, but it's still a relatively small line item. And when you're pushing rents, and we've seen rents push, we have a low-income housing tax credit multifamily portfolio that has had 8 to 11% rent growth every year for the last 4. That is massively compensating for these increases, but it's very difficult for the one-off buyer coming in to get insurance today, and that's difficult.
Jessica, Andrea, Brookfield, big player in data centers, like many others. The development pipeline is huge. Question is how sustainable it is. Cap rates for this asset class sustainable. What's your view getting 2024? We're going to have the same amount of pipeline, or the market will need to be reset a little bit?
On the development side, I think one of the things that's interesting and one of the hopeful signs is if you look at the development pipeline of office, it's slow to non-existent. Yeah. So I think that's going to help if you look 5 years down the road, similar to what's happened with regional malls. You're not going to see that much development. If we continue to have economic growth, you're going to see some of that, step up. Construction financing is harder to come by than, it used to be. So I think only the really great projects are going to get done. 421A running off is, stopping development of multifamily in New York. We've looked at and financed a couple of projects that, squeaked in under the wire. Yep. but I think that's going to slow things down. So, but to me, that's just a little bit of, it's just the constant cyclicality. Like the development pipeline will slow a little bit now because rates are so high that it makes a lot of development less economic. But that's kind of a little bit of a normal cyclical change in my view.
The clock there says we still have 31 minutes, but I doubt it's correct. So I'm not sure if someone can help us out. How long can we?
Give us the hook.
Whatever. We keep on going. I think we have another 5 minutes in my clock. Last couple of questions before we move on. Next year is an important year. Jeff, election in the US. Do you think any implication of this?
I am not touching the political question. My boss, Barry Sternlicht, talks about it a lot. And anything I say will probably be different. Listen, there's always a little bit of volatility into an election cycle. I don't think you're going to have a massive change to commercial real estate values based on it. And I really can't see a massive change to rates, which is all I care about based on it. It's going to come down to the consumer's health. Certainly, if we continue to give out $1.7 trillion at a clip in social programs, then we give the Fed only one tool to combat the inflation that the government created, that's probably not good for the scenarios that we're all hoping for, which is a lower forward SOFR. So I certainly would love to see some fiscal conservatism. But by the way, Trump ran the deficit just as hard up as Biden has run it up. So I think this country is going to look at a higher for longer rate environment because it's what we don't want, but because there's, as it was said here, there's simply too much treasury supply that needs to roll over. When rates start to go down, there's going to be a tremendous amount of corporate and high yield supply. So there's going to be a lot of impediments to going to lower rates, and they're mostly driven by our lack of fiscal responsibility in this country on both sides, and that sort of needs to stop, or our grandkids are going to be paying this bill for an awful long time.
Okay. Closing this panel, there's a lot of young professionals, even students in the room. A message to this crowd. Miriam, you want to start?
Sure, I think this period of time that we're in can be very difficult. Deals are harder to get done. We don't know where values are. There are a lot of question marks, but I would treat this period of time as an incredible opportunity to get experience. So I would think about it as getting as many reps as possible, asking as many questions as you can, and just sort of being in the room where the decisions are made. I think that this is an incredible time to learn.
Yeah, I think that's great advice. I worked at Lehman Brothers leading up to the financial crisis, so I learned a lot as a young person in an environment that was pretty difficult. And this is where you get to be surrounded by people who are experienced but are still trying to figure out a new environment, and you see the thought process that it takes to figure out how to navigate through this, which is the exciting part, I think, of doing what we all do. You also get a little bit of the answer key when you're working a deal in a great environment and you buy it and rates go down and you sell it and everything works great, or you lend money and you always get paid back. Sometimes there can be a little bit of false information there in terms of what really matters. In an environment like this, you see how much every little bit of every deal and every decision you make ends up mattering when things come under stress. And so that's really the best learning environment, so that when we go through our next inevitable crazy upcycle, you learn the discipline it takes to remember what happens when things all go wrong all at once.
Yeah, I would reinforce that. I started at GIC 15 years ago, the week Lehman failed. Sorry about that. Yeah. But you can't underestimate the amount of analytical rigor that you have to spend on deals that are going wrong. The amount of strategic thinking and decision tree exercises you have to go through. It's a much stronger foundation for technical skills and strategic thinking. And the silver lining is you don't have any money to lose yet. So from a personal wealth perspective, I remember the GFC, everyone was freaking out, and I was like, okay, well, we'll do this deal and then we'll go out tonight. So so take advantage of it, have fun with it, and try to learn as much as you can.
Yeah, you stole mine a little bit, but I'd take it a little bit from a different way. I think real estate is the easiest path, modeling-wise and mathematically-wise. If you can add, you can do real estate, and our calculations aren't that difficult. So if you want to be in this business in a down cycle, you're going to learn a lot. If you want to get ahead in this business, look around the room, and I think trying to be the most intellectually curious person isn't always the best thing. I think being less annoying is really important if you're a young person, and that's something that you should think about. And the way to be the least annoying is never ask the same question twice. Just go to the internet, go figure it out. But if you ask the same question twice, senior people are really going to look at you sideways. So just make sure you don't do that.
There?
I think the only thing I'd add is just, you got to be flexible. I mean, don't come into the business thinking, I want to be an originator or I want to do this. Look at where the opportunities are. Look at where people need you, and then, be flexible, because where people need you the most is where you're going to get the most valuable experience. Okie doke. The clock is 0. Again, thanks for the opportunity. I think we're done for today. Thanks a lot for the time.
Thanks, Dino.